Good evening, everyone. Let's take a closer look at today's market performance. Despite headline gains in major U.S. indices at the close, today's market dynamic clearly indicates a bull trap reversal, a scenario we place at a 70% probability. Specifically, the Dow Jones Industrial Average rose 0.6%, closing at 50,579.70 points. The S&P 500 gained 0.4% to finish at 7,473.47, and the Nasdaq Composite edged up 0.2%, ending at 26,343.97. However, it's crucial to note that the VIX Volatility Index, a gauge of market fear, paradoxically climbed 1.61% to 17.03. This simultaneous rise with equity indices is a classic bearish divergence signal. From a capital flow perspective, the market exhibited a strong flight to safety and selective tendencies. Funds are clearly rotating out of high-beta assets like cryptocurrencies and certain tech leaders, moving instead into traditional defensive and value sectors such as healthcare and industrials. Healthcare was the strongest sector today, up 1.19%, while communication services lagged, down 0.54%. Cryptocurrency-related assets broadly fell over 2%, with Bitcoin specifically dropping 2.44% to trade at $75,737.52. This isn't a broad increase in risk appetite, rather, it's a safety in numbers phenomenon within the market, indicating an overall contraction in risk exposure. Reviewing the global market trajectory, Asian markets showed early strength, particularly the A-share Chi-Next index, which surged 2.84%, initially leading global risk sentiment. However, after a strong open in the U.S., a critical turning point emerged during the trading day. Beyond the VIX index rising alongside the S&P 500, semiconductor giant Nvidia also closed down 2.18%, signaling outflows from a key leading sector. This superficial rally, in fact, exposed underlying investor fear and capitulation. Today's market action presented a significant divergence from our previous volatility assessment. While indices posted modest gains, the severe internal divergence and deterioration in risk metrics proved far more complex and perilous than a simple volatile session. We likely underestimated the probability of a bull trap formation. The core error lies in misjudging risk appetite. Investor risk appetite has not improved, instead, it has declined. Capital is merely reallocating within the equity asset class, shifting from high-risk growth stocks and cryptocurrencies to lower-risk value and defensive sectors. The market's pricing priority has clearly transitioned from growth to safety. Even more concerning, new structural signals have emerged with an 80% probability, an extreme divergence between indices and risk indicators. The Dow hit a new high, yet the VIX rose, the S&P advanced, but Bitcoin plunged, the market rose, but bellwether tech stock Nvidia declined. This suggests that incremental capital driving the market has dried up, and existing capital is fiercely battling for safety. These are classic characteristics of a market top. Analyzing the interlinkage of currencies, equities, and bonds, a clear divergence exists. U.S. major indices rose but with fragile internal structures. The 10-year U.S. Treasury yield slightly retreated to 4.56%, theoretically providing support, but the U.S. dollar index, DXY, strengthened to 99.30, indicating safe haven demand that contradicts the equity rally. This divergence implies pressure for Asian markets tomorrow, especially export and tech-dependent indices like the Nikkei and Kospi, as well as A-share tech sectors. Looking ahead, we anticipate a lower open for Asian markets on Monday. The Nikkei and Kospi will directly digest the weakness in U.S. tech stocks. After Friday's strong rally, A-shares will face profit-taking pressure stemming from negative U.S. signals, with growth-oriented Chi-Next likely bearing the brunt. With market top characteristics emerging, most asset declines are a rational revaluation of risk, leaving no obvious, buy the dip opportunities. In summary, we believe market upward momentum is exhausted, facing a potential pullback. The Nasdaq 100 index could retrace 1% to 2% over the next 1 to 3 trading days. Safe haven sentiment is expected to support the US dollar index, testing the 99.50 resistance level. Bitcoin, as a leading risk indicator, may continue to face pressure, testing the $74,000 support level within the next 24 to 48 hours. Market breadth is projected to worsen further, with the percentage of advancing S&P 500 components likely falling below 40% on Monday. Given the current mixed yet predominantly negative signals and extremely poor risk-reward profile, we advise investors to remain on the sidelines or establish hedging positions tonight and tomorrow morning. It is not advisable to prematurely position for any long-side trades. As long as the divergence between the VIX and equity indices persists, we do not recommend any unilateral long positions. Investors should remain highly vigilant, prudently assess market risks, and prioritize risk management and defensive allocations.